Hey, 3 deal structures you must know in order to be successful in real estate. Look, people will talk to you about so many different things: pari passu, common equity, cumulative pref, accrual pref, and even a distribution priority. But look, don't get all confused with all those different things. There's only 3 terms that you really need to understand. That's the pref, the split, and the waterfall. If you understand those 3 different things, you could be successful in real estate and structuring your deals. This is extremely important, especially if you're out there raising capital for these type of deals. So let's get started in there. So the pref is the preferred return. And what that simply is you're clipping a coupon. So let's say you invested $100,000 in the deal, okay? And you got a preferred 8% return. Well, then what you just did was you're getting a distribution of $8,000 a year. At $8,000 a year, so you would get a distribution of $833 a month. Now, here's the thing about preferred returns. If the property doesn't generate enough cash flow, well, look, the sponsor, the developer, does not have to pay that distribution, okay? So that's the only downside about the preferred return. But it can accrue over the life of the project, okay? So for example, you invested $100,000 and you're supposed to get an 8% preferred. If for that year they're doing renovations and the property is not stabilized and they cannot pay it, then guess what? At the following year, if they didn't pay any distributions, you will be owed a total of $108,000. So that's how the preferred return would work. Then the next thing is the split. Now the split can go multiple ways. And here's the thing about splits. For you people out there raising capital and you're always concerned, well, how should I structure my deal? However the deal makes sense. However you can get your investor that certain kind of return, that's what makes sense. You could do 90-10 deals. You can do 80-20 deals. You can do a 70-30. You can do a 50-50. It doesn't really matter. The key thing is whatever split you do, can you get your investor that type of return? Can you get them their 6 to 8% pref? Can you get them 10% pref? Can you get them the equity multiple to 2x? All right, that's how you structure the deal. Now let's talk about a waterfall. Now waterfalls get really convoluted, all right, because it's not so straight cut, dry, chaser, however you want to call it. Because waterfalls a lot of time is when the sponsor is getting a very low percentage. And I don't really say low, but they literally could be only taking 10% of the deal. They're even getting 20% of the deal. And so what happens, the LP typically takes the majority. And the majority waterfall, let's say they're doing that 90-10 to the LP, 80-20 to the LP. Once, let's say the investor invested $1 million. You did a syndication, 10 different people, they put $1 million in, right? What happens, how the waterfall works, once the investors receive 10% on their money that year, then anything over that year, the promoter, the sponsor gets promoted up, all right? So instead of only getting a 10% of the deal, now the split goes to 80-20 or 70-30. The deal started off as a 90-10 split, and it went from a 90-10 because the investor received, let's say by the 6th month, the investor made 10% on their money. Well, immediately after they receive that, the split automatically goes to 80-20. And then let's say the investor made 15% on their money by the 9th month, then it can do another split. And that's what they call a promote. So those things. How do I present a deal you may be interested in? Guys, listen, a great way to really understand these numbers is get that analyzed. I got the Big Deal Analyzer coming out. It's just $1 processing fee, and it'll share with you how to analyze deals in seconds. So those are things you want to use, these tools, to help you get through on analyzing your deals.